In this video, we're going to do 4 rules for scaling into a trade. Stay tuned. Hey traders, a very warm welcome to you. Okay, so scaling into a trade, what is it and what are my 4 golden rules for doing it? I like scaling into positions. I like scaling out of positions. You either love it, you hate it, or you're kind of thinking, no, should I do it? Should I not do it? Is it going to help me not get stopped out? Is it this, is that? The benefits of scaling into a trade are when you know you have a good opportunity to take a trade. The market's coming down, let's say, and you're coming for a long position. You believe, for whatever reason, we don't have to go into why, you believe that this kind of area, let's get a decent color pen out, let's go purple. You believe this kind of area here is a good place to go long for a 4 or 5 day move if you're swing trading, or maybe 4 or 5 month move position trading, or 4 or 5 hour move if you're day trading, whatever. Doesn't really matter the time frame. The point is, you think, okay, I want to go long. Now, what do? You either go all in at this level here, in which case your risk is on fully straight away and you're going to have a stop point. You can't leave it unlimited risk. That's going to be as wide as your money management rules will allow. It might be, let's say it's 25 pips if you're scalping or day trading. It could be 250 pips if you're position trading. The point is it's still going to be a finite level, because your money management rules won't allow you to have more than that, because you can only risk a defined amount. You've got your position size on, that's it, that's the way it is. However, you don't get much flexibility with that. You're in, your stop's in, that's it. There's nothing more you can do about it. Now, in my opinion, sometimes that's the right way to go. There are often all or nothing trade scenarios where the zone is very, very narrow and you're either in or you're not. For example, let's say one example could be we've pushed through, we faked out, and now we're pushing through here, and my entry is kind of a push back through after the fake through the low. To me, that's all or nothing. I'm going in here and I don't really want to be chasing it any higher, scaling in as we're going up, pyramiding in. I don't really want to be adding any more if we go below the low. In fact, that's where my stop is going to be. So in that scenario, the actual premise of the strategy wouldn't really lend itself to scaling. However, we're digressing a little bit here, aren't we? Let's go back to the point, which is, how do we scale in? The rules of scaling in. Let's just imagine that's here and we want to go long. Okay, the first, number 1, is define your zone. That is either, what do I mean by zone? The zone is the area, in this instance we're talking about long, where you're still keen on buying that stock, that currency pair, that index, whatever it may be. That could be narrow. That could be a very small window and you don't want to get involved after that. It could be fairly wide. The important thing is to know beforehand, this is very, very important, where your zone is going to be, because you have to have a level where you say, you know what, I quite like to buy here. It's my fuzzy zone of support, or it's the break through a low that I'll allow it to go, whatever it may be. If you're talking about a pullback, on a drive, and perhaps your zone is going to be here, you obviously don't want to be buying still down here, because that's negated the whole point of the strategy. And really that's a perfect kind of rule to have. The zone is really, the lower end of the zone is where the trade is still valid. Any more than that and the trade is negated and you don't want to be in it. And really, a stop level doesn't necessarily have to be under that zone. You don't have to have your stop there. Your stop can be even lower. But the point is, you say, hey, you know what, enough's enough. This is the only area I'm willing to trade this. And that could be, just get this cloth here, that could be very wide. You could have a very volatile market. You could say, you know what, this is a 200 point zone, 200 pip zone, or $2 zone, or whatever it may be. That's going to depend on the market conditions and the kind of the trade time frame that you're trading. But very important to know when you're going to stop scaling in. The level that you want to get involved in, where you're going to stop doing that. So plan your sizing is the next one. So let's say we now have defined our zone as here. We want to start buying here. We want to end my buying here, and we want to do position sizing. We're going to plan our position sizing. Now you've got a couple of options. You either do standard same position sizing all the way down, or you do a variation of that. So you either go bigger size at the beginning, then add small amounts as you go down, or you flip it on its head and go small position size at the beginning and larger amounts towards the end. there's pros and cons with both, and you can probably see that yourself. If you're going very, very aggressive at the beginning and you're doing a larger position size, let's use for argument's sake, you're doing £10 a point if we're spread betting. So you're doing £10 a point here, okay, and then you're adding maybe 5, 3, 2, 1. The value of that is that if you're right at the beginning, and again, this is something you've got to kind of assess with the trade setup that comes. If you're right early on, you're going to be in still a reasonable size, the price is going to go up, you're going to make good money. And if you're not right early on, if it goes further against you, you're going to pick up more position size as it goes, but you're kind of still going to have the bulk of your position entry is going to be skewed towards the top end of that zone, if that makes sense. If you flipped it on its head, you're going to have, say, £1 a point there, and then you go 2, 3, 5, 10. If it just nudges into the zone and takes off, you're going to be in a small position size that you didn't want. You want it to be a little bit bigger. However, the kind of better the trade, if it's the right strategy, when you get lower into the zone, you're getting more size on, means that you're going to bring your entry even lower, and it's going to give you opportunity then if it pops up to be well in profit for not much of a pop-up. And then the third one obviously is if we're doing equal amounts. So we're doing £2, £2, £2, £2, £2, or whatever it is, £20, £20, whatever your position sizing, it doesn't really matter, but you're structuring it and just splitting up into segments. But the important thing is you know your maximum size. That's very, very important, guys. The amount of people that get caught out doing this, and then they end up with too much size, too much risk, or maybe they don't realize how far it's gone from the first scale, which is why you've got to really pre-plan this. You've got to know where your zone is and know your position sizing, and know you kind of the levels that you're going to add at, and say, okay, well, actually, if I do this, I do 10, I do 7, I do 5, I do 4. What's that going to put me in a position of? Oh, it's going to put me in a position of X pound per point long at this level. My stop is going to be here. My max risk is £800. Is that acceptable? No, it's not. It needs to be less than that. Okay, how can I structure this? Does my first ad need to be less? Do I need to reduce my last ad? You've got to do a lot of planning with this so you don't get caught out. Okay, just going back very briefly before we move on. You know, why would you do a lot of size earlier as opposed to later? So why would you do your £10 here, assuming that's your biggest size, rather than here? Is you might say to yourself, you know what, I believe that perhaps I want to get in earlier because this could take off. And that might be something like this pullback trade. You know, you've pulled back, you've pushed through, you want to get on earlier, but you still believe that even if it does a little bit of tickling around under that low, you wouldn't mind putting some more size on some price spikes to the downside or whatever it may be within your zone. So you might add a little bit more, and maybe you scalp around that. Maybe you have your core position, you add a little bit more as you come to the bottom of that zone. This might take a few hours or a few days to even you know, fulfill itself and kind of come through the other end. So you might even end up scalping at the bottom of the zone, taking some out of the top, scalping at the bottom, taking some out of the top, but still with your core position here. There's other options. The permutations of this are unlimited, and that's why it's such a valuable tool. And it can be confusing, but it's very, very useful, because I don't think very often you get that finite entry, yes, I've got to take it. You know, I think it's very good often to scale in and give yourself a little bit of room to breathe. All right, let's move on. Number 3, ignore price behavior. This is something really that I put in here because, you know, I did struggle with a lot, especially with day trading. I would say to myself, okay, I'm going to scale into this position. I've got my position size. I know what I'm going to scale in and the levels I'm going to scale in. And when I'd scaled in, I would be so focused on that price behavior that I would almost second guess myself for the next scale and say, oh, I don't like this. You know, I'm already in a loss. I said I was going to add some more here, but, you know, I don't like the look of that candle. You've got to just be committed to the plan. And, you know, this is stuff we talked about before with trading plan. The plan's the plan. If in your plan you say, I won't scale if I see this price action, then fine. But otherwise, you've got to pull that trigger again, regardless of whether that price action, what it's doing, whether it's a deep red candle or whatever, assuming we're talking about a long here, you've still got to say, hey, I'm going to do it, even though you're losing on your initial position, because you've got to think of the bigger picture. The bigger picture here is I'm trying to capitalize on this little burst of volatility to the downside for a spring back up to a mean reversion trade, whatever it may be. So ignoring that price behavior once you've got your plan. It sounds counterintuitive, it sounds a bit stupid, really, but once your plan, the whole strategy is in place, you need to just execute it as you've planned it, as opposed to looking once you're in the trade and perhaps being spooked. Perhaps you end up closing some, this and that and the other, and you end up messing up the whole point of it, which is to scale into a trade giving yourself opportunity for it to pop back up, you know, when it does a little bit of work to the downside here. And the final thing, number 4, is being strict with your stop. Oh man, this is a big one as well. Hands up, been caught out on this before. You know, you've got to say, hey, my exit is here. Obviously not with the axis here. My exit is here. That's my stop position, or I'm having half out here, whatever it may be. Of course, you can scale out stops if you like. But the point is, you've got to be so strict, because this can get nasty very quickly, especially if you're scaling in. You're still scaling, you're in the worst position. You're wrong with the biggest size. Of course, that's the danger you can do, which is why some people don't like it. But I believe if you structure it right and you know your max size, it's no different to having your full size in the middle of it. But a lot of people mistake it, and they scale in, and they add, and end up being in the biggest position in the trade that's going against them. And all it needs is a last little spit to the downside, and they're wiped out, because they're in a huge position. Their average entry is way up there. They can't stomach it anymore, and they're out. So you've got to manage it correctly and be very strict with your stop loss. Know when you're going to exit, when you're going to enter. To be honest, it's when you're going to enter, when you're going to stop scaling in, and then when you're just going to dump the whole lot. And that really is the crux of keeping this kind of strategy managed from a risk perspective. From a target perspective, whatever your trading plan happens to be, but from a risk perspective, knowing when to start, when to stop, the position sizing, and most of all, when to cut the whole thing and get out of it and say, you know what, I'm wrong, next trade. All right, guys, 4 rules for scaling into a trade. Comments in the comment section below. Thumbs up if you like this kind of stuff. Subscribe if you haven't yet already, or consider doing so anyway. And I'll see you in the next one. Take care. Goodbye. Keep the risk managed.